A very relevant topic is the determination of the eligibility criteria for the guarantor. In this regard, understanding the prudential work carried out by Susep is very important. And to learn about this work, we have Carlos Queiroz with us today. Carlos Roberto Alves de Queiroz has been a director at Susep since 2022. He is responsible for prudential supervision and reinsurance supervision. Graduated from the University of São Paulo, USP in economics and law. He has been a federal public servant for over 21 years. He has worked at Susep since 2010 and was the interim superintendent of the agency between January and April 2023. He represents Susep in Cormec, Committee for the Regulation and Supervision of Financial Capital, Insurance, Pension, and Capitalization Markets, and in the National Strategy to Combat Corruption and Money Laundering, ENCCLA, the PGFN Ordinance 2044, which came into effect on March 1st, 2025, refers to Susep Circular 691, which came into effect in 2024. Let's understand the details of the notes more thoroughly. Settlements of this new circular. Carlos, thank you for accepting the invitation and participating in Desvert Academy. It is an honor for us to have you here with us today. Briefly speaking about an introduction to the topic, the PGFN Ordinance 164, which was in effect for a decade, already referred to the certificates issued by Susep. But in the new ordinance, which came into effect in March of this year, there are consequences and measures due to possible notes that the insurer might have. So, bringing it in a very objective way in the presentation of the guarantee or in the renewal of the guarantee, the certificates need to be presented, and depending on the notes that the insurers present, the PGFN can not accept them. There is, in the ordinance itself, a mention of some specific notes that prevent the presentation of the guarantee, including the renewal. And here's something important to mention, is that if the insurer has any relevant note during the term of the policy, the PGFN can notify the insurer and the policyholder to present or to regularize the insurer's situation, or then to present a new guarantee. And if it is not presented during the term of the policy, then it would be characterized as a claim. And the consequences are quite harsh and objective and quite pragmatic that the PGFN brought based on transparency, which the new circular, which came into effect last year, the Susep Circular 691, brings to the insured. I even understand that the very proposal of the circular would have been this: having you and your team participated in the drafting of this circular. I would love to have a bit of an introduction to what led to the publication of the circular.
So I want to read. Alina, first, I want to thank you for the invitation. I am also quite honored to be here on your podcast talking about surety insurance, which is a subject, an extremely important product among the products supervised and regulated by Susep, and to talk a bit about this project of the certificate regulation. How are you? As you well mentioned, previously the Office of the Attorney General of the National Treasury, PGFN, required a certificate from Susep, and the certificate that Susep provided, it basically certified whether that insurance company was qualified to market some type of product. It simply provided the information that it was authorized and could market. For example, a surety insurance contract. It was a very simple document, and a few years ago, we understood that it would be interesting for the market. Insurance market, and here understood as the insured, the policyholder, the broker, the reinsurer. The other insurance companies and the entire ecosystem, which needs the proper functioning or functionality of the insurance contract, it would be important for Susep to provide a bit more transparency about the actual situation of its supervised entities wise, especially the insurance companies. Then the idea arose to have, in addition to the certificate that confirms the registration of that insurance company, which would be the current licensing certificate, we would also have a certificate of annotations where through information such as it states or it does not state. So the interested party could know if a certain insurance company is experiencing any kind of problem, any kind of difficulty, especially from a prudential point of view, or if it is in default with the supervisory body, with Susep in any way. So the main objective was to make the certificate or this system of certificates function as a supervisory tool. It would be an additional incentive, even a measure of enforcement for the insurance companies to maintain the compliance with all Susep regulations, especially those that refer to its solvency, its prudential situation. So it's very important to highlight that now any citizen can, based on the name of the insurance company, know if it is meeting the prudential requirements, the solvency requirements, if it has assets above the minimum required capital, if the technical provisions are effectively covered by guarantee assets, if it is responding to any supervision or regularization plan, or if this plan is not being fulfilled, if it provides the information so that the supervisor can perform their work, if it responds to the supervisor's notifications. So this certificate system and this regulation that came to discipline here, the circular Susep 691, clearly had this objective. And we are very happy that the expected effects are happening. And besides the PGFN and other public bodies, they are also using the certificates so that their contracts or their contractors present the policy of insurers that are effectively, let's say, up to date with the supervisory body, which is Susep.
Interesting. We will go into each of the points to bring a little more clarity for the insured who will analyze the certificates so that they have a bit more clarity regarding the denominations and the reason for the comparisons. But it's worth highlighting here that Susep published a manual, and the link is even available in the certificate itself, and it's really well done. The manual provides, we will talk here today about the explanation of each of the points, but the manual provides precisely this explanation so that you can, as an insured or as a market agent, better understand the meaning and in a comprehensive and detailed manner comprehend and interpret the points more effectively. But before we get into it, today we will go through all of them. But before we start, Carlos, I would like to take a step back and kindly ask you to explain the prudential function of Susep. I usually summarize when I talk about Susep that the function, the reason for the regulator's existence is to ensure the rights of the insured by maintaining a solvent market. But I would love to hear your definition, you who have so much experience working in this area for 15 years.
All right. The main law, the main guideline, the main regulatory document we have in our market is Decree Law number 73, dated November 24, 1966. And it is right there at the very beginning in Article 2, that in the insurance market or in the national private insurance system, state control will be exercised in the interest of the insured and the beneficiaries of the contracts. So, this mandate is very clear. It is very transparent, very simple to understand, and very difficult to execute, but it is already presented as a guideline right in the second article of the decree law. And this, let's say, is the North Star that Susep, its employees, its board, need to have in order to perform a good job. Taking a small step back, I think it's also important to make it clear to the audience, not everyone is very familiar with the insurance market, that the official regulatory body is the National Council of Private Insurance, and Susep is the supervisory body. The CNSP is a body composed of Susep, the Ministry of Finance, the Ministry of Justice, the Ministry of Social Security, and also the Central Bank of Brazil, and this is the regulatory body that issues the regulations. Obviously, these regulations, the vast majority of them, I would say 95% of them, are all developed within Susep and are proposed by Susep itself to the CNSP. Yes, in this context, Susep also, besides proposing resolutions to the CNSP, carries out complementary regulation. So that, and it is This committee, which meets regularly once every 3 months, does not need to delve into the details of all the products, of all the regulations that are necessary for the insurance market. So Susep is an auxiliary regulatory body and also a supervisory body. And to carry out supervision, today, Susep adopts the internationally prescribed model within the scope of the IAS, which is the National Association of Insurance Supervisors. We adopt the Twin Peaks model in the same way as the main developed countries in the world. So our supervision has two peaks, the Twin Peaks model. They are twin peaks and both need to have the same importance for the supervision to be successful. So it's the prudential peak. To verify, from a quantitative and qualitative point of view, compliance with prudential rules, the rules aimed at ensuring the continuity of the company, aimed at ensuring sustainability and avoiding systemic risks in the market. And the other peak, the conduct peak, which is where it is assessed whether the companies participating in the market are providing or offering fair and adequate treatment to consumers throughout the entire cycle of the product's life. So these are our supervision. It has these two biases, right? And because they are, and even to ensure they have the same level of importance, they, internationally, in some countries, are even carried out by different bodies. An example is England itself, or within the same organization by different departments. So the conduct supervision here at Susep, it is carried out by DISU, which is the department currently headed by Director Julia Lins, and the prudential supervision is conducted in my department. I have been in this position since the year 2022. For some time, I even temporarily held the position of Superintendent of Susep, and then I returned to the Solvency Directorate. So our focus, now speaking specifically about the Prudential Directorate, prudential supervision and what we are concerned with. The Brazilian model is quite inspired by international models, also quite inspired by the Solvency II model, which should even have an equivalence to the European standard. But we do this a bit in the Brazilian way. We still adopt some additional requirements so that our supervision or the regulation itself is a bit more conservative than the European standard. Internationally, we have been trying to evolve in supervision, to evolve in resources, both human resources and technological resources, so that we can perhaps bring the regulation much closer to the solvency model too. But at this moment, we still do not have the security to do so, because Susep still needs to mature and have more resources to be able to execute supervision. Because when the rules, these international rules, they have a greater degree of subjectivity for the operator. So the actuary or accountant of the company, they have a more freedom in professional judgment to make accounting entries, to establish the technical provision, or even to define the level of capital. So at this moment, Susep has a regulatory standard of prudential requirement adhering to the international model, but with some restrictions and with some slightly more conservative rules. Okay? And how do we execute this? We have within the sub-directorate, the Prudential Supervision Directorate, we operate with 3 general coordinations, which is our division of labor. So supervision can be done in 2 ways, remotely or on site. When we have remote supervision, we call it monitoring, off-site monitoring. Through monitoring, the staff working there, the units, they evaluate the information that the supervised entities periodically provide to Susep. In our case also, we have a quite large informational requirement, the FIP. It is submitted, the periodic information form, it is submitted to Susep on a monthly basis. And this is the basis of our supervision. we have one, and this supervision, it is basically done on 4 different subjects, okay? So we have there a coordination dedicated to the evaluation of technical provisions. We have another coordination dedicated to the evaluation of the assets guaranteeing the technical provisions. And we also have another area focused on the evaluation of risk capital in order to verify if, in addition to the technical provisions and the assets, if the capitals are effectively constituted. And we have another coordination that deals with the adequacy of accounting information, if everything that is being disclosed by the company is indeed adequate, or if what the independent audit is also evaluating is indeed adequate. So our monitoring is done in these 4 areas: provisions, assets, risks, or risk capital, and accounting. And then we have the field work, the actual inspections or on-site inspections, as it is said in international jargon. These same issues are evaluated there in a context of closer proximity to the company. So the objective of the on-site inspection work is to verify, based on the documentation, support from the documents that are in the company, that are in the company's systems, from the issued policies, from the received claims notices, whether the information we receive periodically is correct. So it is another layer in remote monitoring. We trust the information that arrives, and in field inspection, we verify if the information that is sent is indeed consistent with the company's operations, contracts, commitments, and obligations it has undertaken. And here I talked a lot about quantitative issues, capitals, provisions, and in assets. Now, we also conduct evaluations within prudential supervision of qualitative aspects. And then we have a third area, a third general coordination, which conducts evaluations related to the company's governance, the internal control system, and the risk management structure. And all those other requirements that the regulator starts to bring to the market, for example, sustainability, cybersecurity, all these aspects which are complementary to the activity and aim to provide either security for the operation itself or to meet broader regulations in the sense of, for example, data protection. So all these aspects, all these qualitative checks are also verified from a prudential point of view. So we have the remote aspect on site. We have the quantitative bias and the qualitative bias. So we have thus quite a lot of confidence in the sense that our supervision is comprehensive enough to provide assurance to Susep and to society that our supervised entities are, from a prudential standpoint, adequate, that they are secure, that they have, let's say, sufficient assets to meet all their responsibilities with all the obligations undertaken.
Very interesting, a very robust work that is done to ensure the solvency of the market. And I think the result of this is also the number of companies. I think it's been almost a decade since we've had any company enter special administration.
Exactly. This is a reason for, let's say, it's quite a historic milestone. It's the first time in all of Susep's existence. Susep will turn 60 next year, and we have gone 9 years without any special administration events. Obviously, we had some companies that went through problems, went through some crises, but all of them were managed. It's why? Because our supervision, besides having all these biases, all these different perspectives, it also has a very strong preventive focus. So when we say that our rule is conservative, it contributes to this result. When we say that our rule also adheres to international standards, we always seek the best standard, the one that is the safest. And that provides peace of mind for the insured and for the beneficiary of the insurance contract. So we have been 9 years without any declaration of special regime, and all the crises, all the problems we had, we managed with an approach that is first preventive, where we seek to alert the company before the harmful event occurs. And we call them in for a conversation to try to understand why there was perhaps a sudden change from 1 month to the next in the composition of net worth or in the composition of the guaranteeing assets. Secondly, our approach is also corrective once the event itself already constitutes either an irregularity or a deficiency in internal control. We have corrective instruments to prevent that situation from worsening and to bring the company back to compliance. A great example of this is the solvency regularization plan, the coverage regularization plan for technical provisions. And when all this framework eventually does not work, we move to the sanctioning standard. So during this period, although we did not have any company under special regime, that is fiscal management, intervention, or even liquidation, we did have some irregularities. And they are judged in a transparent manner. And we have even seen the press, from the moment the meetings of the Susep Board of Directors began to be broadcast live on YouTube, there was also an increase in transparency regarding the irregularities practiced in the market. So we have seen some supervised entities, some former administrators, and even some auditing firms being penalized by Susep. Due to past events, and it's important, the sanction also has an important function in the sense of repressing the event that occurred and preventing it from happening again. In other words, it should serve as an example for that company and for all others in the market.
So, to summarize, in a few words, our solvency rule is more conservative than international standards. There is a robust effort carried out by Susep to monitor the market's solvency on a monthly basis through the periodic information report by the supervised entities, in addition to on-site inspection activities. And all of this has led to a very positive outcome for the market, where all the incidents that occurred were handled in a preventive manner and resulted in the fact that in the last 9 years, we have not had supervised entities under special regime. Now, delving a bit into the circular to give us a bit of insight, especially for the taxpayer who is going to present a guarantee and needs to understand, interpret with better level of knowledge what the points brought by the circular mean. We know I think there are 12 different points. I'll bring the circular with us. There are 15 different points, but the PGFN already clearly states that the first point, which is the relationship between the adjusted net worth and the minimum required capital, if the minimum required capital is less than the adjusted net worth and there is no solvency regularization plan in progress, the insurer is prohibited from presenting new guarantees and renewing the guarantees already presented. The second aspect also prevents the presentation of guarantees and the renewal of guarantees. It's the relationship you already mentioned, but we will go into a bit more detail, which is the relationship where the amount of guaranteeing assets is less than the need to cover technical provisions. And the other three aspects, which are considered as impediments, are the prudential, preventive, or precautionary measure in force that is not complied with, and the establishment of special supervision, and finally, the establishment of a fiscal management regime or intervention. So, among the 15 points presented in the circular, these would be the impediments to presenting new guarantees or renewing the guarantees already presented. Of course, it also allows for the possibility of interpreting the combination of points and to express an opinion and notify both the insurer and the policyholder based on the interpretation it makes of the points. But if we could start, Carlos, by talking about what, in my opinion, might be the most important, the comparison of adjusted net worth with the minimum required capital It's very interesting for us to explain the composition of the minimum required capital, especially considering companies that are not in the insurance sector. So, what are the risks that are understood? And the meaning?
Okay. First, I think it's worth mentioning that out of the 15 points, I think the PGFN was quite wise and chose those 5 that would be more sensitive or that would increase the risk for fulfilling the guarantee. I think that post-surety insurance has a very important social function. I think it's a very interesting instrument and it has grown significantly. Over time, it has been widely used, and I believe that the PGFN selected those points that indeed put the guarantee at risk, especially in tax executions, which is the focus of the attorney's office. Now, speaking about the minimum required capital, I think it's important for those who are not from the market. Insurer, and I will try to be didactic here because the subject is quite dry, but it's important for the person who will interpret or who will watch. Our podcast can have a view of the balance sheet, an accounting view, quite simplified. I will try to be more like this, to have this view that in the balance sheet of an insurer, there are first the liabilities. I will emphasize this first, the obligations. First, you take on the contract. The insurance contract is a random contract. So when underwriting an insurance contract, the insurer first assumes a risk, and the revenue, even because it cannot recognize the revenue in accounting terms at the first moment. It has to defer and recognize this over the duration of the contract. So first, the insurer has an obligation. It has a technical provision. It has a liability. And to guarantee this liability, it needs to have assets. So if the insurance pricing was perfect, it was actuarially fair, correct. And if the event and the future correspond to that pricing, in theory, you have the provision adequately constituted and you have the guaranteeing asset of good quality, you would not have an additional risk. In a perfect world, it would be enough for the asset to cover the liability, which would be the expected loss. The expected loss. In that group, in that insurance portfolio, because the contract is part of a portfolio, in some claims occur and in many others they do not. So first of all, having this balance sheet view, the insurer needs to adequately constitute the liability and then have the guaranteeing asset it's exactly in its possession. And then only that this perfect world I mentioned, it does not exist. The insurer is subject to various risks. And what if it priced incorrectly? Exactly. If it might have priced incorrectly, in fact, pricing is never accurate. You never hit the exact value to the decimal. Not to scare you, but anyway, you have this risk of pricing not being correct, either higher or lower. And our concern is that when the pricing is wrong for lower, exactly, and then you wouldn't have the asset, you wouldn't have the revenue to cover that expense. So to deal with this risk, these risks that the insurer is subject to, they need to be reflected somewhere. This will be reflected also as an obligation. So the insurer, the pricing risk is the risk of that liability being measured incorrectly, it being less than it should be. It's a risk of underestimating the liability. This is closely related to underwriting risk. So the underwriting risk is the risk that the underwriting or the underwritings being done, underwriting is the process of accepting the policy. It's the risk of that underwriting not being correct. It's the risk of having priced it lower than it should be. So with each policy that the insurer, it needs to reflect this risk also in its balance sheet. It needs to have capital to cover this risk. So this, let's say, is the main risk of our business, and it is a risk different from all other economic sectors. Only the insurance market has this underwriting risk. Speaking broadly, speaking in general terms, we have pension products or other types of products that have a risk with this designation or concept. But anyway, the insurance market, it is vast. This underwriting risk is the main risk. So going back to that balance sheet perspective I mentioned, you have the technical provisions and its risk is not adequately measured. It is undervalued. This is the underwriting risk. Wow. But you also have other risks associated with the insurance activity, such as the risk of asset realization. So, for example, if you have the counterparty risk, not paying for that asset you accounted for. This is very important in surety insurance. If the policyholder does not pay the premium to the insurer still needs to guarantee the risk for the insured. And this risk also needs to be measured in the balance sheet. And here is an example of credit risk. It is the risk of that debtor not honoring the payment of their liability, which would be the insurer's asset. And there are also other risks, for example, market risk, the risk of having a cyclical problem in the Brazilian or even global economy. This risk also needs to be measured. It needs to be considered in the calculation of risk capital. For example, interest rate risk, inflation risk, exchange rate risk. Depending on the company's operations, it needs to recognize this risk and have a capital margin, a capital reserve to cover that risk if it occurs. So we have talked so far about underwriting risk, the risk of undervaluation, basically the risk of asset undervaluation, the risk of pricing error. We talked about credit risk, which is the risk of the insurer not receiving the entitlement it has. And speaking of market risk, but there is also operational risk. Operational risk is the risk of problems within the company's structure which cause it to incur losses. And this risk is, by the way, it may not be the most relevant, but it is the most difficult to calculate. However, in any case, Susep provides in its regulation appropriate methodologies for calculating these risk capitals and the sum of these risk capitals. They are the sum of this. They constitute an institute that we call the minimum required capital. So an insurer, beyond the technical provisions being adequately constituted and the assets guaranteeing these provisions also being adequately purchased and guaranteed, ensuring this position of the insurer, it also needs to have an amount of capital also covered by high-quality assets, which can account for or face these risks that are inherent to its operation. So that is what the minimum required capital is. So eventually, when an insurer has an adjusted net worth below the minimum required capital, it means that it does not have high-quality assets sufficient to cover the risk it has in its portfolio at that moment. So, when this happens, Susep notifies the insurer to present a regularization plan. This plan can last up to 18 months, this regularization period. Very few situations have reached this entire 18-month period. Most are resolved. Often they are resolved. Even before the notification arrives, the company has already identified and resolved it. Eventually, it's a specific issue. Many times it is resolved in 2-3 months, other times in 6 months. Eventually, it can take up to a year in a regularization period. But this happens when the high-quality asset, in addition to that necessary to cover the technical provisions, is not sufficient to cover the risk capitals, to cover the minimum required capital. So that's what it means, a situation where it doesn't have the sufficient assets and has an unfulfilled plan. It's a reason for concern because this company is at risk of continuity. And that's why the PGFN imposed this restriction in offering the guarantee.
So, in summary, in a perfect world, the guaranteeing assets would be sufficient to cover the obligations assumed by the insurer. And to identify additional risks. In the operation, aspects of underwriting are observed, that is, business acceptance, credit, meaning the receivables, the credit quality of the receivables of that insurer, market risks, which would be risks beyond the company's control, within the market where it operates, the market risks to which it is subject, and operational risks, which could also lead to unexpected losses. And it is. By looking, each of these risks is quantified, which would then be in addition to the values recorded in the liabilities. And it is compared with the value that the company has in adjusted equity. So if unexpected events materialize, that is, if any of these risks materialize, the true company would then have equity to respond to the materialization of these risks.
Exactly. Just to make it clear for those watching us, the adjusted equity is the company's own accounting equity. However, for the calculation of equity, as I say, they must be high quality assets. Some items can be deducted, for example, tax credits that have a low likelihood of realization or other assets that are not considered of good quality. For solvency purposes, they can indeed be realized, but for solvency purposes, we need, in fact, a very strong assurance. So some assets can be excluded from the equity calculation, and one of them is EE1. An analysis of the company's portfolio can also lead to additions to the net equity accounting. If it has a very favorable long-term portfolio, it has a favorable liability adequacy test, it can have economic benefits in the calculation of the adjusted net equity. Just to explain the difference in net equity, as I started by talking about a balance sheet view, you have the asset, it is equal to the liability plus the net equity. The adjusted net equity is considered the accounting net equity. With adjustments, generally, these are deductions of low-quality assets for solvency purposes, which ensures that the coverage of this additional risk that companies face is well guaranteed. And if that event occurs, it can respond to it in the short term.
Understood. An important aspect for the insurance market is the reinsurers. And if you could briefly comment on how it is considered, the counterparty risk of the indemnity payment by the reinsurer in the back minimum required capital. It is also a credit risk.
It also enters as a credit risk. So one is the risk, which is ceded to the reinsurer. It is recognized in the insurer's balance sheet, and you establish, according to the possibility of the event occurring, a reinsurance asset. This reinsurance asset is also evaluated from the credit risk perspective. So depending on the insurer's rating, depending on whether it is a local admitted or occasional insurer, because this relates to the possibility of realizing the asset, there is obviously much greater control when the reinsurer is local. So generally, the risk that is recognized as a percentage for the calculation of credit risk capital. When you have a local section or reinsurer, it tends to be smaller than with a foreign reinsurer. Similarly, the reinsurer, which has a rating better, as reinsurers are, continuously analyzed by risk and rating agencies. When you have a reinsurer with a better rating, the credit risk is lower. Worse rating, increased credit risk, aggravated, and the insurer needs to address this risk by establishing high quality equity.
Excellent. So, when is the counterparty risk analyzed in relation to the transferred risk? For the reinsurer, it is understood that the credit quality of the counterparty is analyzed. And for, in this categorization, the reinsurer is considered the best credit risk, followed by foreign entities, which will be subject to the applicable rating.
The calculation considers a mix of both factors. So there is a range of percentages for the local reinsurer according to its rating, and for the foreign one as well. So it's a mix of these two situations to establish the constitution.
And there's an interesting comparison. We've been following it for many years because it's available on the Susep website, the relationship between the minimum required capital and the adjusted net equity. And when we look at this relationship, especially as we follow the insurance market that deals with surety insurance, we observe that among the 35 insurers, several show very latent, very significant solvency. Sometimes the adjusted net equity represents 3 or 4 times the value of the minimum required capital. It easily represents 1.5, almost 2 times. So the relationship between what is the minimum required capital to cover the inherent risks of the insurance operation and the adjusted net equity. And then my challenge whenever I analyze this number is to put it into perspective, because among the 35 insurers that operate with surety insurance, only about 10 insurers have ratings granted by risk rating agencies. And when I put this into perspective, I see the quality of the information and the relevance of this comparison between the adjusted net equity and the capital. Minimum required and how it can be used by decision makers of the requirement of the guarantee, so the insured parties, when they define the eligibility criteria of the guarantor. Because there are insured parties, both public and private, that still require a rating as a condition, a minimum rating granted by the demand of risk rating agencies. And when we observe that the market has information that is of very high quality, the result of a very robust work of monitoring and supervision of the insurance market carried out by Susep. I would like to hear your opinion regarding this perspective of solvency assessment from this angle, comparing these two parameters and the potential no requirement of a rating, both by public and private insured parties.
The sufficiency. We call this situation of adjusted net worth being higher than the minimum required capital as capital sufficiency. Obviously, the greater the capital sufficiency, the more comfortable it is, the solvency situation, and the lower the risk that the company will face any economic or financial problems, right? I know very little about the work of the rating agencies. We had a contact where one of them offered a presentation to Susep about the methodology. Anyway, it's a job that didn't impress us much. The work of the rating agency, the work we do at Susep, is a job that, in fact, we know. And it is continuous work. As I mentioned, the monitoring is done on a monthly basis for most of the requirements. And the on-site inspection itself also considers the company's risk, and it also has consistency. Quite relevant or quite interesting. We do not consider within our evaluations whether the company has a rating or not in the case of insurance. Reinsurance is a bit different because as we deal with international companies that are outside the scope of supervision and that we do not know, we end up relying on risk ratings for reinsurance purposes as far as reinsurance is concerned. But regarding the insurer, well, I don't think this restriction of having or not having a rating adds much. It ends up being an additional cost for the company. The hiring, with all due respect to the work that rating agencies do and to the professionals who are involved, but anyway, I really don't know if sporadic evaluations that occur once a year in a process that usually lasts 2 weeks will bring a privileged insight into the actual situation of the company. My opinion might be somewhat controversial for those in this market, but from the experience we had, a work interesting, but it didn't impress us. Anyway, so I think that, especially when it comes to the insured in the public sector, the requirements to operate, they are the legal requirements. It is, then obviously that demanding an additional guarantee can be interesting depending on the contract and everything else. But anyway, it seems to me that there might even be some questioning regarding bidding equality. making additional demands beyond those stipulated by law or those set or disclosed by the market's own supervisory body, such as specific guidelines?
That's great, Carlos. Thank you. I think it was very clear for our audience. The work done by Susep is truly impressive. It's something that can make international markets envious. As we mentioned, the ability to monitor the guaranteeing assets daily and have them under custody and suspend commercialization. I think it was a point that drew a lot of attention. The monitoring work that Susep does, based on the report, granular information from the market, supervised monthly, also brings the visibility and a very important preventive action by Susep. And that generates the results we have been observing in the supervised market, which makes us very proud. Thank you very much for your contribution, for your presence, for your availability. And to you who are with us, I thank you for your audience, and we will end here. A hug.